All right. So I'm going to share my screen. And so this is about securing your future now and in retirement. And for those of you who don't know me, by the way, I'm Pauline Field. And what I do is I coach people on retirement, how to do it, when to do it, what to do once you're retired, and so on. And by the way, I am retired and I'm working. And I coach people on navigating this transition. And there's a whole lot to think about when it comes to that. And just a few of the things: when to retire, what to do when you retire, who to do it with, where to live, how to stay fit and healthy. What about if you're single and retired? And for that matter, what about if you have a spouse and you're retired, or a partner? And also about the later years. And I did a survey a while ago, and I asked people, what are the three most important things? People who are already retired, what are the three most important things about retirement? And the answer that was most common was, get your finances in order. If your house is paid for, you have peace of mind that is just, there's nothing like it. So that's why I put the picture of money up there, because it's a big factor. Let me tell you about Jim. Jim has seen firsthand how the loss of income can ravage a family's finances and force children and parents to hawk everything they own, including their home and their heirlooms. The whole experience can be heartbreaking. He knows because his family assets evaporated when his mother needed care during her advanced years. For that reason, he's dedicated the rest of his professional career to helping others avoid the financial meltdown associated with a reduction in income because of a disability or the need for long-term care. And the risk is really real and significant, because about 70% of us will need help putting on clothes, taking baths or showers, preparing meals, taking medications, staying hydrated, shopping, driving, visiting the doctor, and even just remembering. Think about it. A person cannot perform these activities, if they can't perform these activities themselves, and needs the help of a salaried caregiver or a nurse 24/7, where will the money come from to pay for these care services? Jim has been providing long-term disability and long-term care insurance services since the 80s. Over the years, he's helped people facing virtually every disability and long-term care scenario possible. Seeing the smile of relief on his clients' faces when they know they have a plan in place that provides care services and mitigates the loss of everything they've worked for keeps him motivated to help others. And for the things that I've learned in knowing Jim is that there are plenty of people who sell insurance, and oh, by the way, I can also tell you about long-term care insurance. But Jim is a specialist. He knows the ins and outs. He knows the gazillion companies there are that offer these programs and these insurances. And he, as it says here, he knows all the services. And so I'm going to stop sharing the screen. And let's hear from Jim. So Jim, you've had a long career helping people with long-term care insurance services. Tell us, why did you get into this business?
I don't know. After the introduction, my inclination is to say, any questions? As it said in the summary, Pauline, and thank you very much for asking me to do this today. I always love talking about this subject because it's so important. And how I get into it was in the summary it suggested. My mom, who had inherited money from her grandmother, would tell me and my brother and sister occasionally as we were growing up that when she passed, all that money would go to us. And I know my parents had some struggles along the way, but she would never touch that. And I know it pissed my father off to no end. So because it was critical that she pass that on. But that's the beginning of the story. In the late 90s, she came down with cancer. Bless her heart, she fought real hard for almost 4 years, and at $100,000 a year, all that money evaporated. And I had been in the insurance business already for a couple of decades and said, holy, does anybody recognize about this black hole that's out there ready to swallow up your independence and the money you've been able to earn over your life? And so that's when I said, okay, I got my insurance agency back east that continues to run quite well without me. I know that because they call me occasionally and they send me money every month, which leaves me free to be able to educate people about how important it is to prepare for the last quarter of your life. And that quarter is now pushed out. But it used to be my grandparents, if they got to mid 60s and 70 years old, that was considered the end. And medical science keeps pushing that envelope further and further back. Doctors, medical community, their mission is to keep people alive. What we don't prepare for, and God bless you, what you do, Pauline, is get people's attention about how important it is to prepare for retirement. And now it's important to prepare for when you don't have the ability to take care of yourself and you need to have support and help from other sources.
Great, great. Jim, there are about 10,000 people in this country who are turning 65 every day. And that'll be the case for a few years. So there's lots of people who are realizing that they need to be thinking about their transition to retirement. And many of those I talk to are ill-prepared in many ways. So tell us about long-term care insurance and why it's important to be thinking about it before they retire.
I'm doing another seminar next week, and the title of that one is the Baby Boomers Budget Busters. Because what's going to happen with all of these people who are retiring, half of these people are going to rely on the government for their health care when they get older. And it's called Medi-Cal. And in California, it's very easy to apply for Medi-Cal. There's no asset counting, and you can get a good lawyer to prove that you don't have any income. Now you're on the state plan. Okay, great. What's wrong with that? What's wrong with that is the state's plan. This is health. It's government health care. And you may end up having to go to Hemet for physical therapy. It depends on where you go. People who have, let's say it another way, it's always has been true that people with money get better care. That's true now, and it always will be true. So having money to be able to hire professionals and to pay for it keeps you from having to be on the state plan and take what they give.
Okay, yeah. One of the most common things I hear is that people are just wanting to make sure that they have their finances in order so they can travel, they can play pickleball, and do all the other things that sound like fun things to do in retirement. But they don't think about a time when they might need care, either at home or in a facility. What does it cost for professional caregivers, for instance?
There's long-term care isn't a place. Long-term care is a physical or a mental breakdown where you need help with your activities of daily living. As you articulated, Pauline, bathing, dressing, eating, toileting, transferring, and cognitive impairment are issues that cause the need for long-term care. And families jump right in. There's no question. And usually, if they're nearby, the oldest daughter is the one who has to give up their life to provide the care. That gets old real fast. And that's when you want to be able to call in the cavalry and say, okay, we're going to start paying professional caregivers to provide this care, whether it's in a home setting, whether it's in assisted living or board and care, or whether it's in a memory care unit or in what we call it senior living locations. They used to call them nursing homes, but that's a passe expression now. And the cost of that care, at home care, I don't know, $40 an hour. Doesn't sound like much, but generally it's 4 hours minimum for a good home care agency. And what happens when it becomes 6 hours a day or 8 hours a day? It transitions generally into board and care or assisted living. These are unique to California. where people have a house with 4 or 5 bedrooms and they get a license to provide long-term care in these houses. And they have caregivers who take care of people. Really cool idea. And that's depending on where it is and the kind of facility, $5,000 to $6,000 to $7,000 a month. And if you transition into a memory care or long-term care facility, you want a private room, nice and clean, good meals and everything, 14 grand a month. That's what it's going to cost. These are the reality. Or, as I said before, you don't have to worry about any of that stuff. Just go on the government plan and you'll be in a room with 2 or 3 other people. And so that's what the government has. The government is going to provide that care, but you're not going to like it.
Wow. Yeah. $14,000 a month. That's just mind-boggling.
Yeah. I mean, that's high end. That's a suite, maybe just 2 bedrooms. Or wait a minute, Valerie's got her hand going.
Right. Yeah. You're muted, Valerie. Valerie.
Sorry, I muted myself and forgot. I'm never mute.
Any of us who know you, no, that's true.
All right.
Hypothetical, Jim. A 50-year-old decides they want to purchase long-term care insurance. And they want the royal treatment. They want to be able to have that $14,000 or the equivalent when they need it available. What is it going to cost them?
A single female, age 50, who's in good health, can probably plan on spending $10,000 to $12,000 a year for a long-term care policy that will provide first-class resources to pay for care.
What is the cost of living or inflation factor in these policies? Let's say this individual doesn't need it until they're 80 years old.
There is a range. You can do 1, 2, 3, 4, or 5. All insurance companies offer all 5 levels of inflation protection on the important parts of the insurance policy. And what I hear these days, 4 or 5%, in some places maybe 6% is what the cost of care is experiencing. I always provide people, look, you got to have something in place, because when that caregiver comes to your home and says, okay, we're going to provide this for you, provide this way, somewhere on that intake, they're going to say, how are you going to pay for it? And if you can slap down a policy with $300,000 or $400,000 or a good sum, okay, you're in the door. Now you get good care.
So the policy would have a collective value, not a monthly value.
Thank you. That's a good question, Valerie. There are 3 important elements to a long-term care insurance policy. There's the total benefit, and we call it the money pool. And that's the $300,000, $400,000. That's the total amount that the insurance company is going to cover to provide you with care. Then the second important element is, how is that paid out? They don't give you $300,000. They pay it out on a monthly basis. Maybe it's 5, maybe it's 6, maybe it's 10, maybe it's $14,000 per month that they will pay for. And then the third most important element is the inflation factor. And that was a good question, Valerie. You want that $300,000 to try to keep up with inflation for as much as you possibly can. Good question.
Thank you.
So to add to what Valerie was asking, so in that scenario, what if you run out? If you have spent the $300,000 that you had in the policy, are they just going to throw you out?
That's a really important question. It depends on the facility. And that's one thing that I counsel people is, if you've got a limited policy with 300,000 or 400,000, when you check in, you want to say, look, if I run out of money, I want to be able to stay here. And that becomes part of the agreement. If you don't confirm that going in, yeah, there's a possibility that they can say, I'm sorry, you're out of money. You're going to have to find someplace else to go. But you want to confirm that going in. In most places that I know of, and I make a point of visiting as many of the senior living places and memory care facilities as I can. And I have never heard anybody say, well, you come in with 300 grand, we're not going to throw you out when you run out of that money. That doesn't mean I haven't seen them all.
Yes, and there's quite a few of them. So
I have a follow-up question to Valerie. Excuse me. You're saying you're paying like 10 to 12,000 a year starting at age 50. Is there ever a time you're not paying per year? Is there a way to get that full value at some point?
Good question. Yes, the insurance companies, most of the insurance companies have a premium payment period. Try doing that 3 times after a martini. You can do a 10 pay, you can do a 20 pay, you can get a contract that's going to be finished at the point where you say, okay, I'm going to have reached my peak earning years by the time I'm 75, and I don't want to pay premiums after that. Now, that said, that sounds good, but it doesn't mean that the premium, it means the premiums will be higher because they're going to collect the same amount of money. They just compress it into a shorter time period. People with money, I'm working with a woman right now who's pretty well off, and she's putting $200,000 single premium. Okay, she's moving her rainy day fund into a long-term care policy. While that rainy day, that $200,000 is sitting in the policy, it's generating $500,000 worth of long-term care. And if she decides in 6 years or 7 years that things have changed, she doesn't need it, she get all the money back. But you need to start out with a significant deposit in order to have a deal like that. But to your question, Alan, yes, that you can have contracts that will be paid up in a specific period of time.
Interesting. Another question that we've got from Carol. What price do you estimate for live-in round-the-clock care? If you want to stay at home and you need care.
Now, Carol, really want to hear that. $27,000 to $30,000 a month for 724 care.
Wow. 27 to 30,000?
And just count it, $40 an hour for 24 hours a day, times 7 days a week, times 365 days.
Wow.
And people do. There are people, in this California, there are people out there that have that kind of money.
Yeah.
In fact, what's interesting, Pauline, is that the same person I'm working with right now said that you've got all this money. Why do you need long-term care? She said, Sonny, she called me Sonny. I didn't get this money by being stupid. I know how to leverage my dollars, and I'm going to move it over here, and this is what I'm going to get from it. That made me laugh. But it was a point, but she was smart with her money. That's how she has it.
Right. Another comment is that a friend strongly suggests title lock. If you own your own home and has all sorts of insurance, is this title lock necessary? Another layer of another company knowing about my assets concerns me.
Can you do that again? Is it in the chat?
Yeah, it's in the chat.
Okay, to protect what one has acquired, a fine friend strong suggests title lock. I'm not sure I know what title lock is. If one owns home and all sorts of insurance, is this title lock necessary? I'm not sure.
Could I explain?
Please, Carol.
That was my question. It's the idea that people have been, will all of a sudden find out that someone has somehow gotten their name on the deed to your house and has borrowed against that from the bank. They've absconded and you owe the bank some unaffordable amount of money and maybe not even the title to your house.
I would like to address that, Carol.
Thank you very much. And then another layer of another company knowing all about me and my assets also concerns me in this time of so much fraud. Okay, thank you. I'll go mute now. Thank you.
Thanks, Carol.
Carol, I would like to address the title lock issue. I'm a veteran real estate agent. I have done this for decades. It is in California extremely difficult for the situation you describe to ever take place. There are so many locks, there's so many incredible protections for Californians. California is a consumer-oriented state and very much so in real estate. I would not spend money on something like that. Please do not do that. And please do not advise your friend to do that. Periodically, you can do a title check. It is very difficult for somebody else in the state of California to attach anything to your title and to take their name over and to refinance that. But periodically, it certainly doesn't help for you to reach out to a realtor and say, hey, would you check my title, make sure there's no issues there? Any realtor who's consumer oriented, customer oriented is going to do that for you. And it's quick, it's no cost to us and it's no cost to you. So please don't worry about that.
Thank
Please,
you so
let me
very,
assure you.
thank you so very much. And that also confirms, Valerie, I spoke to a lawyer about that. And she said to speak to my estate lawyer, and I did, but was uncertain. And I didn't like asking him a serious question because of that. He's healing for some years. But at any rate, the lawyer I spoke to said that if there was ever anything happening to your property, you get a letter, and it's not just something you could overlook, like it's marked big and red and stuff. But thank you. I'm going to write that question to myself to ask.
And if you're interested, get my information from Pauline and reach out to me a couple times a year, and I'm happy to make that check for you, believe me, or for anybody.
That's very
Peace of
kind.
mind is invaluable, so I'm happy to do.
Good
Thank
connection.
you. And I do have some friends in real estate in the area where I live. Thank you so much, Valerie.
Very welcome.
The question is, would you mind checking my title, my property's title?
I would, I'll get my information from Pauline and I'll be happy, reach out to me. I'll be happy to do that for you.
Yeah, Carol, I'll get you Valerie's information.
A good
All right.
connection.
All right, Susan says, what if you never need to use the policy? Is there any value to you or your family?
Great question.
Great question. Okay, there are two kinds of long-term care insurance policies. Let me say it again, two kinds of tax-qualified long-term care policies. A traditional style contract, generally it's like your home insurance or your auto insurance. If you have an accident, your house doesn't burn down, the insurance company sends you a thank you note for all the premium paid. There is one insurance company out there that has a 10-pay contract, so you're done in 10 days, but that's the end of it with the traditional contracts. Hybrid contracts are really a combination of long-term care policies and life insurance policies. These are very attractive because they do three things. One, they'll pay for long-term care expense. Two, if you die and never use it, they'll pays out like a life insurance policy. And if somewhere down the road you say, I don't really need this anymore, they're going to give you some or all your money back. And those contracts also have the limited pay options as well. So if you have a hybrid policy, it's going to pay off no matter what.
Right.
People like those contracts.
Yeah. All right.
Jim, can I ask a quick question on that too? I think you mentioned something about a 200,000 policy giving you $500,000 worth of coverage. Is that some kind of a certain type of policy that like appreciates?
That's the hybrid policies are the ones that have those options to it, where you can do a single premium, and most often the money really doesn't get spent. It really just sits there, and while it's sitting there, it's providing not only an additional life insurance contract, but also the long-term care benefits.
Next question. What is the difference between assisted living community versus long-term care facility?
Okay, let me go. I think I said this in the beginning, that long-term care is not a place. Long-term care is the medical or a physical event where you need help with your basic activities of daily living. And that can be in a home care setting, it can be in assisted living, it can be adult daycare, it can be in a memory care, or it could be in a senior living facility. So this is all codified in regulations. Some time ago, 1995, the insurance commissioners of the country created a model law, which all long-term care insurance companies have to follow, that include the elements I mentioned before about what the important parts of the contract, as well as many other bells and whistles if we can, but things that become very important when somebody goes into care.
Great. Many people think that by the time they're 60 years old, it's too late to get long-term care insurance. At what age should people be getting it? And for those already retired, can they still buy it?
The insurance companies stop. Most insurance companies don't go over age 80. One insurance company, MetLife, in fact, just came out and said they'll write contracts up to age 85. So there's really no age limit up to that point. The risky part, of course, is that somebody says, I don't need it right now. I'm going to wait another year, or I'm going to wait 2 years, or the risky part of waiting, of course, is that a diabetic condition is going to creep in, or something is going to happen that takes that option off the table. So that I try to encourage people to say, look, get something in place as soon as you can and as young as you are. But don't let age stop you if you're healthy enough to qualify. A third of the population over age 70 gets declined because they have a condition. The insurance company says, now there's too much risk in this one and we won't issue a policy. So the sooner you get it, the better off you are, and not put it off, because the risk of the consequences of being declined changes everything with your family.
So if you're really healthy at whatever age, and number one, you probably won't get declined, and maybe it's even going to be less expensive. But what about if you have? So are you going to be declined at whatever age if you have certain conditions?
Yes, and it's a long list, but it's and our practice in our company is we go to an insurance company. Somebody says, okay, I think I want this thing. We get the medical information right up front, and then we circulate it anonymously to the insurance companies to say, does this look like an insurable risk? And if they come back and they say, yes, they may have a question here or there, but this looks like a good risk. Then we can start the process of looking at different models. Why bother doing that? Because if you get declined for insurance, the declination ends up in your permanent record in the Medical Information Bureau. Now, the MIB, most people don't know about it, but every time you get a prescription, every time you go to a doctor and he writes a note, you have a medical procedure, that information goes into the Medical Information Bureau. And if you want to go for a loan or you have some other transaction down the road, that financial institution is going to go to the MIB to say, okay, let's see what's going on with this person from a medical side before we complete the transaction. So we try the best we can to prevent people from being declined for coverage, because it becomes part of the permanent record.
Okay. Yeah, so that's another good reason, as you said, to not wait, but to get it as soon as you can.
Absolutely. Absolutely.
Yeah.
Once you get to a point where something happens and you can't get it, your options become very limited. And you have to go to the family and say, hey, look, this condition has come up. I can't get insurance anymore. Let's plan for what's going to happen when I'm in my 85 years old or 90 years old, and lay out a plan, because it's going to be expensive at that point. And the families, they jump in the middle, but it gets the caregivers get sick themselves when they've had been in the breaches of helping somebody for a period of time.
Yeah. Okay, this is so good. I'd like to open it up and see if anyone else has some questions about this.
I have another question. Jim, can you explain the tax issues you're saying, like when you have insurance under your business, or just explain tax consequences, the benefits you could get?
Thank you for opening that door up, Alan. Again, I mentioned the National Association of Insurance Commissioners have this model plan for tax qualified long-term care policies. That means two things. One, every dollar that comes out of a long-term care insurance policy for long-term care is tax-free. Okay, so that's why this older woman, 72, says, okay, I can leverage my money. My 200,000 is now worth 500. So the benefit side is tax-free. Premium-wise, the government does things to try to encourage people to create their own long-term care safety net. And one of the things that they do is allow for the tax deduction of premium. Now, a person, an individual, would write a check for the premium, and for a standalone person, then that would become part of the 7.5% medical deduction. However, if you have an LLC or a sole proprietor, an S corporation or a C corporation, premiums are tax deductible, which is a big deal, and that the deduction goes up in different, the tax deduction, if you're, let's say, from 51 to 60, you can deduct up to $1,700. If you go from 61 to 70, now you're talking $4,700 of tax deduction. Over 70, now it's almost $6,000 in tax deductions that you can take if it's paid for by a business entity. Or if it's not, then you have to reach the 7.5% medical deduction, as which shows up on line 14 on your 1040. That's a good question.
Yeah.
I have
indeed.
another question. I always been wondering, because you say if you get declined because of medical reason for life insurance, that it goes into a permanent record and it be there for the rest of your life. What about if you get a DNA test and it turns out you are subject to get there's certain disease in the future? It doesn't mean that you have it, but it could be. Does that the insurance companies would not want to insure somebody that has, what do you call it, disposition to certain illness?
When an insurance company gets an application, they do three things. One is they're going to go to the Medical Information Bureau to see what's in there. Secondly, they're going to go to the primary care physician or a specialist if there's a special involved, and they're going to get the medical records. And then thirdly, on the hybrid policies, and actually most of the traditionals as well, there'll be a phone interview. The phone interview is designed to confirm everything they've already learned and primarily make sure there's not a cognitive impairment. They look for that when they do the telephone interview. So the underwriter gets all this information out together and looks up on a screen and says, okay, we will issue the policy. We will make an offer to cover this person. Now, when that offer is presented, then the applicant then makes the decision whether they want it or not. Does that answer your question?
No, not really. I was saying, so the DNA, like my DNA test is, I don't know if it becomes part of the, what do you call, the Medical Information Bureau. And
Yeah.
it's saying that I have the family history of breast cancer. So would
Yeah.
would the insurance have access to that DNA test that I took, like you do on your own? Not necessarily your doctor has done that test, but that a lot of people do that 22 and
23andMe. Yeah.
where you get your DNA history, like where
Yeah.
you come from and all that, but it also shows the predispositions that you have for medical illness.
There's no DNA testing and such, but you make a good point that the information, if you've had the BRCA test for breast cancer, the fact that you had the test is in the records. And most likely there's no, they don't tell you in that report whether it was positive or negative, but they will come back and they say, okay, what's the family history? And yeah, it could have an impact. Now, if you've had the BRCA test yourself and the insurance company says, hey, look, we got this, we know you had it. Can you tell us what the results were? Okay, then now the underwriter has confirmed information that yes, the MIB says that you had the test, you're confirming that it came out clean, and they probably want your primary care physician to confirm that as well. But then it's no longer an issue, even though there's a family history.
No, okay.
Very
Now,
good.
one of the things that is become very popular is with the underwriting is family history of Alzheimer's. That does create, in most cases with some insurance companies, they'll limit the amount of coverage if there's a family history of Alzheimer's.
Okay, there's another question in the chat. How do you call long-term care coverage plus life insurance? If long-term care is unused, will it increase the cash value of life insurance?
Yes, how do you go? They're called hybrid policies, Steve. And yes, if the long-term care policy is not used for long-term care, and if 10 years down the road you say, I don't need it anymore, they'll give you some or all your money back, depending on at what age you applied, how much you put into it. And of course, if you just let it sit, then it's going to either pay off for long-term care or it'll pay off like a life insurance policy. Does that answer your question, Steve?
Yes, so what percentage is return to cash surrender value of life insurance?
It increases every year. Some insurance companies put more emphasis on the long-term care part, and some insurance companies put emphasis on the cash value policies. Like Mass Mutual is very heavy into creating more cash value at the expense of more long-term care. Other insurance companies like Lincoln are Nationwide. They figure if you're buying a long-term care policy, you want long-term care coverage. So the cash value element isn't as great as it would be with Mass Mutual, but the long-term care coverage is much bigger than what you get with Mass Mutual.
I love that idea that they just think it as a whole life insurance policy, but if something happen, it can be used as a long-term care. But of course, to cover those, I have to pay the premium. So that's why I'm asking what percentage of unused long-term care can be brought it back to whole life insurance.
All of these
Cash value.
policies are whole life policies combined with long-term care. So the cash value builds up on a guaranteed basis. And what percentage? It depends. And I hate doing that. That's an insurance answer to everything. But it does depend on how much premium has gone in, how long it's been in there, and at what age did you take it out, and what's your life expectancy. There's a lot of variables that kick in. That's an illustration. We can take a look at that, but there's no way to know. I can't give you a percentage on it because it depends on a number of factors.
Okay, thank you.
Okay, Carol, yes. You're muted.
Thank you.
There you
I'm wondering, Mr. Better, you said you described the nursing home, convalescent home, could be two people in a room or something, and not acceptable. There's one friend that I have that I go see her a couple of times a week, and she's in such a place. She doesn't have much memory. She sometimes falls and needs to stay in bed a long time, but then sometimes she's up. At any rate, she's served her meals, or she can go to the dining room when she will. And if one was in a condition like that, I don't find it unacceptable. It's clean, and has one's food and rest and a roommate. And so what I'm wondering is, if one found oneself to be in a condition where one needs round-the-clock care. I have taken care of that situation in my own home. I know about that. But if one was then alone and found oneself in that position that needed round the clock and did not want to spend 30 to 40,000 a month again, at any rate, is there a way to leave? I think the place that my friend is in, I don't know if it costs her anything or if it's one of the state things. Is there a way to leave your assets and money to your beneficiary and then go be in such a place and then just die there?
Sure. Get a good estate attorney who knows how to hide assets and hide your income.
Oh, you have to hide it, huh?
Yeah, they have to hide your income. There's no asset test in California anymore. But if any income over $2,000 becomes now you have to share costs. If your income is more than that, you could end up paying the whole thing with very little being
Oh,
paid.
I see. Thank you. That makes sense. No, I was not looking for a place to hide it. I just wondered if that's a possibility. No, I see. You can't just have it taken over by the beneficiary and then that makes sense.
Yeah.
Okay.
just as we're coming to the end of our time, what are the one or two things you'd really like to leave our audience with, Jim?
All right, let me do it this way. I have fun sometimes just writing limericks. And this is in honor of one of my very first clients in California some time ago. The sky is clear and I'm bathing in the sun. Powers of attorney and insurance plans are already done. Plans are well laid and the premiums have been paid. Now I can spend the rest of my money just having fun.
I love it. I love it. That's great.
All
Let
right.
me just share my screen again because I want to give you Jim's information. And also, if you want to continue the conversation about designing your ideal retirement, we offer one-on-one coaching as well as group coaching, what we call the Feisty and Fearless Circles. And you can book a call with me, and which is a discovery call, and we'll do a free assessment to see how I can help you. And to contact Jim, it's jimbetter@essentialplansusa.com is his email address. And you can call the office at 562-424-1155 or his cell at 603-964-2020. So I wish you much love and laughter.
Yeah. Thank you. And thank you, Pauline, for the opportunity to talk to all you guys. Hope that I helped out.
Thank you. Thank you so much. Thank you,
Everybody.
Jim and Valerie and everyone. Thank you.